John, let's look at the math of how we actually move the needle on this portfolio.
You got it. And, most people, they get stuck thinking they have to pick a lane. Am I a trader doing the fast math for a quick win? Or am I a holder playing the long game with slow math? But that's not the whole picture, is it? It's really a false choice.
Exactly, and that's really the big question we're tackling here. Do you really have to pick a side? Or is there a much more powerful way to bring these two forces together?
Okay, so let's jump right in with the first gear, arbitrage. This is what we're calling the fast math. Now, let's be clear, we're not talking about the old school arbitrage, buying a stock in London and selling it in New York for a tiny profit. That's a game for supercomputers and algorithms now.
For an everyday investor like you or me, the game has changed. It's all about what we call retail arbitrage. And look, this isn't about guessing market sentiment or trying to predict the future. It's pure math. It's about spotting a very specific, temporary, and get this, predictable gap where risk has been mispriced by the market.
Right. And the absolute classic example of this, the clearest way to see it, is a merger. It's a perfect real-world scenario. You've got company A announcing it's buying company B for a set price. You see this stuff in spin-offs and special dividends too, but mergers are just the cleanest way to explain it.
So let's just use some round numbers. Say the official buyout price is $100 a share. But maybe there's some regulatory stuff, a little market doubt, so the stock is still trading at 95 bucks. That $5 difference, well, that is the arbitrage gap. It's a defined mathematical opportunity right there in plain sight.
And that gap, that's your fast math. It's an incredibly powerful tool for generating capital, for getting ahead. But, and this is a big but, it's a tactic. It is not a complete strategy. You just can't build a 30-year legacy on finding little gaps. For that, you're going to need a totally different kind of math.
So let's shift to that second gear and see how this really starts to build. We're talking about compounding. This is the slow math, the undeniable force that builds real generational wealth over the long haul.
Oh, for sure. I mean, there's a reason they call it the eighth wonder of the world. It's one of those things that sounds so basic, but people almost always underestimate its true power.
Okay, and this is so important. We're not just talking about earning some interest here. That's simple interest. Compounding, now that's the math of reinvestment. It's all about the discipline, taking whatever you make, whether it's from one of those arbitrage plays or just your regular dividends, and immediately plowing it right back in. You're feeding the engine. Exactly, and you can see how it plays out over time. In the first few years, honestly, the growth feels kind of slow, almost like nothing's happening. But then you hit this magic inflection point, maybe around year 15, year 20, suddenly the money your past earnings are making is bigger than the new money you're even adding. Your money is officially doing the heavy lifting for you.
That's the snowball effect we're talking about. And the biggest risk here? It's just impatience. It's so easy to get caught up in the excitement of the fast math, chasing those quick wins, that you forget to just let the snowball roll, to give it the time it needs to really build up some serious mass.
And this is where it all comes together. It's not about fast math or slow math. It's about understanding how the two gears work together in one powerful machine. It's about building yourself both an edge and a fortress.
That's the perfect way to frame it. Arbitrage, your fast math, is how you find those tactical edges. It's the spark, it's the fuel for your engine. But compounding, the slow math, that's how you use all that fuel to build an unshakable financial fortress that can stand for decades. And if you take one thing away from this, let it be this. Use arbitrage to find your edges, but let compounding build your fortress. One generates the opportunities, the other turns those opportunities into real lasting wealth.
So there you have it. That's the strategy. Two very different but totally connected gears. The real question isn't which one's better. The question is, how are you going to use them both? So that's the choice, really. Are you just focused on finding the next gap, the next short-term play? Or are you also patiently, consistently letting that snowball roll down the hill? The question we have for you is the same one we started with. Which gear will you turn to really move the needle on your portfolio?